uh, finance versus accounting, no sir. And then we moved on, and then like you told about various aspect of financial management, like procurement of fund and utilization.
Then what else?
And then the use of procurement of fund is like to minimize the cost, and then for the utilization of funds is to maximize the returns.
Yeah.
This was the main point.
So we
And
have to,
every department is dependent on financial department. That is
sir, yeah, exactly. Good, Balakrishna.
okay.
So today we are going. I've just stopped with mentioning you about the two objectives or the goals of financial management. So one, what we have is the profit maximization, or what we call it as the wealth maximization. And I also told you in short the difference between the profit maximization and the wealth maximization. So every company, the company that has been registered under the Companies Act, they aim for achieving the goals. So what goals they achieve? One is profit maximization, other one is the wealth maximization. Now, what is profit maximization? See, conventionally you can say that profit maximization, or it is believed that that will be the ultimate object of any business entity. So the company should take decisions keeping in the mind the profits of the business. See, profit maximization can be one of the best objectives of financial management, but that alone cannot be an objective. See, there is something more than the profit. You understand? So every company, the ultimate objective, or they should keep in the mind maximizing their profit. So how do they maximize the profit? Maximize the sales, minimize the cost. Maximize the sales, minimize the cost. Got it? See, the next objective that you have is wealth maximization. The wealth, we also call it as the value maximization. And you know something? This is the appropriate objective of the concern, to raise the market value of the firm. Now, anyone can tell me, what do you mean by the market value of the firm? What do you mean by the market value of the firm? What do you
Share
mean by the, yeah. Yeah, tell me.
share market value, sir, of one
Share market only, you're right, man. But can you tell me, what is the market value of the firm? You're right. I'm not saying you're wrong. But what is the exact definition? Or what do you mean by that? Because in all the
So the
chapters it
stock
gives.
price.
Yes, per?
So the stock price of the respective company.
Stock price, okay, that's what he also said. But can you make it more apt? I'm just typing it in the chat. 1 minute, I'll just post it in the chat.
Number of shares into cost per share, sir.
One minute, I'm just typing now. 1 minute. Yeah. See this. Market value is the term used to describe how much an asset or a company is worth on the finance according to its market participation. See, simply you don't get the market value. Your participation should be very effective. And it is commonly used to refer the market capitalization. That is, can be done through the wealth maximization. Yeah, somebody said, which is calculated by multiplying the number of shares by the current market price. So, number of shares into the current market price will give you the market value of the firm. If you want, I'll put the formula also in a very simple way. The market value of the firm, please don't forget this, is equal to number of shares, okay, into the current market price. Please don't forget this. This we are going to use for the entire syllabus. Market value of the firm is equal to number of shares into the current market price. So, to raise the market value of the firm, and the wealth of the shareholders can be ascertained through cost benefit analysis. Have you heard about this word? What is cost benefit analysis? What is cost benefit analysis? What is cost benefit analysis? Anyone? See, cost benefit analysis is generally what? You should have heard about this term. I'm just typing. One minute, I'm just posting it. All the terms used. Yeah, 1 minute. Somebody is asking me to add. See, actually, I have to set right all this. Vignesh? Vignesh, yes.
Sir. Yes, sir.
I have added in.
Yes, okay, sir.
Right now we can join the course.
Yes, sir.
Yeah. See, I'll just set right before you come for the next class because I've taken the list, but I have to do all this. Yeah, tell me. What is your cost? I'm just typing it. Cost benefit analysis. I'm just typing it in the chat. Cost benefit analysis. Yeah, you can see now. It can be explained as the procedure for estimating all the cost involved and the possible profits to be derived from a business opportunity or proposal. Dinesh R. Dinesh R.
Yes, sir.
I'm giving you one small work today. Go to the
Yes, sir.
Google.
Yes, sir.
Type various types of cost. So you'll have like fixed cost, variable cost, opportunity cost. Like that, you'll have different costs. Okay.
Yes, sir. Yes, sir.
Take that, put it in the group. Let students learn.
Okay,
Let your
sir.
friends learn.
Okay, sir.
Like what is fixed cost? You produce any number of units, the cost will remain same. Okay.
Okay.
What is variable cost? The cost varies. What is
I
opportunity cost? What is opportunity cost? Shukla. Shukla. Very important
Yes, sir.
cost. I give you a beautiful cake. Okay. Shukla.
Yes, sir.
I give you a very beautiful cake. Will you eat the cake or keep looking at the cake? Whether you'll eat the cake or keep looking at the cake.
Sir, I will eat the cake.
So when you eat the cake, you cannot keep looking at the cake. Am I right?
Yes, sir.
To get the benefit of something, you have to forgo the other thing. That is called opportunity cost. It's clear to everyone?
Yes, sir.
It is clear. Yeah, okay, Shukla. It's clear to others?
Yes, sir.
Yes, sir.
When
Yes,
you want
sir.
to get the benefit of something, you have to forgo the other thing. Benefit of other thing. That is called, like this, you'll have so many costs where Dinesh will post it today and you can go through it and come. So the cost, again, Balakrishna has posted something good. Cost benefit analysis, the process used to measure the benefits of a decision or taking action minus the cost. So whatever the cost involved, you minus it. That is how you do the cost benefit analysis. Adjusted according to the time for which money is invested and risk involved. The firm value is reflected by the market value of the company share. Okay, market and the what is the earning per share? Who's the owner of the company?
Shareholders.
All the shareholders,
Which shareholder? Equity shareholder.
equity shareholder.
You know what is your earning per share? Profit after interest, tax, preference dividend divided by number of equity shares. That will give you earning per share. I'm just putting it in the group chat. Those are all the fundamentals. You should be thorough. Earnings per share is equal to net profit after interest I mean interest on bank loan, tax and preference dividend divided by number of equity shares, which we call EPS, net profit after interest, tax and preference divided by number of equity share. That will give you earning per share. So when you want to decide how much shareholders are getting it, then only the shareholders will know whether he has maximized the wealth. In order to know that, you have to calculate earning per share of the each, which act as a performance index of the firm progress. In this way, this will be what is wealth? The present value of the benefit minus the present value of the cost. How do you express your wealth? Wealth is nothing but what is the present value of benefit minus the present value of the cost. It's clear to everyone?
Yes, sir.
Any
Yes, sir.
clarification? Any clarification? Shall I proceed? Right. Now you should know the difference between profit maximization versus wealth maximization. So profit maximization object is what? Large amount of profit. Advantage, easy to calculate profit. It is very easy to create a link between financial decision. So with the profit, you can clearly take the financial decision. Disadvantage, profit is only for short term. So you want profit, you try to ignore the risk and uncertainty. Ignoring the timing of you want to make the profit. You are not bothered about if I invest today after 2 years. No. Require immediate resource to make profit. But stockholders wealth maximization is the object is highest market value of the common stock. For long term, it takes into risk and uncertainty. You will consider when you're going to get the return, whether short term, medium term, or long term, and it considers the stockholders' return. Return on investment, ROI. Whatever I put, how much return I'm going to take. There is no relationship between financial decision and stock price. Stock price every day, it just booms. It sometimes comes down. So you cannot take any decision with that. So what happens when you cannot take any financial decision? It leads the management or it makes the management to feel so anxiety and frustration. So wealth maximization, something talks about the value maximization, which can be decided based on your earning per share. The earning per share is nothing but profit after interest, tax and preference dividend divided by number of equity shares. Sir, how do you get profit after interest, tax and preference dividend? 1 minute, I will show you. I will just close this and then I will show you. 1 minute, because everything you should learn in detail. Otherwise, tomorrow when you go for the other bigger chapters, you will find it difficulty. You will have some difficulty in learning. Yeah. Why I am teaching all this is going to support you for doing your J component. You can see. Can you see the vertical form of income statement?
Yes, sir.
Yeah.
Yes, sir.
So we have sales less returns. Whatever you get back, net sales. Less cost of goods sold. Sir, what is cost of goods sold? Opening stock of material plus purchase plus direct expense. Sir, what is direct expense? Anything that is directly connected with your production minus closing stock. Opening stock plus purchase plus direct expense minus closing stock will give you the cost of goods sold. So net sales minus cost of goods sold, you get gross profit. If your sales is less than your cost, it is a gross loss. If your sales is more than your cost, it is gross profit. So from the gross profit, you minus all your operating expense. So what is this operating expense, sir? Administrative expense, all your office expense, selling expense. One example of selling expense is what? Bad debt. Sir, what is bad debt, sir? I'm just telling for an example. I'm just giving for an example. I have given 100 rupees to Balakrishnan one day. I know that 100 rupees will never come. I have given 100 rupees to Balakrishnan. He has taken 100 rupees from me one day. But I know that money will not come. It is almost like an expense. So it is the bad debts. Are you clear or not?
Yes, sir.
That is why they say, write it on Gandhi. Nobody can go and ask Gandhi. They'll say Gandhi's account. Okay, that is called bad debts. Suddenly one day Balakrishnan comes and gives me 100 rupees. Bad debts recovered. That is a income. No, that is not an income, that is a gain. But this is an expense. Selling expense. What are selling expense? Salesman salary. Then you got distribution expense, packaging. Goods what you produce, you have to send it out for sale, carriage outward. Traveling salesman salary. All this will become operating expense. Okay, then operating, non-operating income. Suddenly you sell this table. The table worth is 1,000 rupees, but you purchased the table for 1,000. Suddenly when somebody comes and asks me, somebody comes and asks you, I'll give even 2,000 rupees. You give me the table. 1,000 rupees is the operating, non-operating expense, depreciation, any fall in the value of asset. As you use the asset, wear and tear. So if you minus all this, you get profit before interest and tax. Less interest on loans, any loans that you have taken, profit before tax, less tax, profit after tax. Now, are you clear how you got profit after tax?
Yes, sir.
I'll even share this today. I will share it to Rishita. Rishita, you can put it in the group. So this is about, you have to learn about wealth maximization. Okay. Next, what are the key decisions of financial management? I think so already I've told you about this. Key elements, aspects, but these are the key decisions that you have to take. Please don't forget, our entire syllabus is going to revolve around these 3 decisions. Investment decision, financing decision, dividend decision. What is investment decision? Capital budgeting. What is capital budgeting? Investment on the fixed asset, long-term investment. So you invest in one fixed asset today, but the benefit you will be receiving after a period of 1 year, 2 years, 3 years. Am I right or not? Do you get the benefit immediately?
No, sir.
That is called capital budgeting. What is working capital management? The capital that is required to run the day-to-day affairs of the business. Generally, this is supported with something called, in an accounting language, we have 2 working capital. Net working capital, gross working capital. What is net working capital? Current assets minus current liability. Anyway, what is current assets? Which can be easily convertible into cash, cash in hand, cash at bank, stock, all that. What is current liability? Which are paid within the period of 1 year, creditors, bank overdraft. Today I'll be sending you few materials about all these assets, liability, everything. So please take care of that. Go through and come. Any doubt that will be. So what is this working capital management? It is like a capital that is required to run the day-to-day affairs of the business. So what do you do with the working capital? Working capital, how do you get? You get the stock, you sell the stock, convert into money, and you make. This is called working capital management. So how do you do? You have a cash, buy raw materials, convert the raw materials into work in progress, finished goods. Convert the finished goods into cash. Again, you get the raw material. Are you clear?
Yes, sir.
Yes,
Yeah.
sir.
Then we are going to talk about financing decision. What is financing decision? Cost of capital. Like, what is the cost of equity share? What is your cost of debt? What is the cost of preference share? All that you're going to learn in detail. Then the capital structure, how you're going to leverage between your cost and your debt, between your equity and debt. You should try to balance. That is what you're going to do. Then dividend decision, dividend policy. How you are going to take a decision to pay the dividend amount to the equity shareholders. The dividend will be generally declared at the end of the assessment year. What do you mean by assessment year? 1st April to 31st March. What is the assessment year? 1st April to 31st March. What is the financial year? Suppose your assessment year is 1st April 21 to 31st March 22. Your financial year will be 1st March 20 to the 31st March 21. What is your calendar year? 1st January to 31st December. So only during at the end of the assessment year dividend is paid. Now what is the retained earning? The owners of the company are equity shareholders. Now what you are going to do? You will have the profit. Once the profit, you pay tax. Once you pay the tax, what the company do? They pay dividends to the shareholders. Once you pay the dividend, transfer some money to reserve because future is always uncertain. I told you already, your reserve is like a shock absorber in your bike. So when there is up and down, the shock absorber will help you for a smooth ride. Like that, this year you will have a profit. Next year you cannot expect same profit because Omicron will come, then Delcron will come, then Diomicron will come. So many things will come. Okay, so you will not have a smooth functioning. So that time, the amount whatever you have transferred from this year profit, that will support you. After doing this, some amount will be left. That will go to the owners of the company, equity shareholders. That is called retained earning. The amount retained by the owners of the company is called retained earning. Are you clear?
Yes, sir.
Yes. So I'll stop with this. I know you're all very angry on me, feeling hungry. Listen here. Tomorrow we'll have a clear project discussion. Tomorrow we'll have a clear project discussion so that you can prepare for the review 1. And this unit 1, I'll complete it on Thursday. Okay, so tomorrow's class, please, Rogan.
Yes, sir.
You and your, who's the other girl? Tanvi.
Me,
Both of
sir.
you, please try to take all the list by tomorrow. When you come to the class, all the list should be projected with 70 names.
Yes.
And by tomorrow, before you come to class, I'll remove all the people who are not there in the class. So please, all the 70 names should be there with what topic they have chosen, 1, 2, or 3. Ask them
Yes.
to put the number and you have to share it in the class tomorrow. Once
Yes.
you share that, whatever the doubts they have regarding the projects, I will clarify. And next week, I have called an expert to brief you on this project so that you will be pakka ready for your J component. And today I'll be sharing you the vertical form of the P&L account. I'll be sharing the vertical form of the balance sheet, income statement, balance sheet, list of assets, list of liabilities. Please go through and come so that will help you to go ahead with my classes.
Okay, sir.
So, Rishita,
Yes, sir.
you have to forward the attendance to me.
Okay, sir.
From anyway, I am also downloading. You also forward the attendance so that I can have I can check. Okay. Thank you so much. See you tomorrow. Bye.
Thank you, sir.
Thank you, sir.
Bye. Bye.
Thank you, sir.
Thank you, sir.
Bye. Thank you.
Thank you, sir.
Thank you. Bye.